The trade everyone copied too late. It started as a quiet success, the kind that spread slowly through performance reports, investor letters, and closed-door conversations, long before it ever reaches the headlines. By the time most people noticed it, the trade no longer belonged to the few who understood it, but to the many who trusted it. To understand why this pattern still defines modern markets, we need to look past the trade itself, because what mattered was not the idea, but the timing. And timing in markets is rarely shared equally. At the beginning, the trade solved a real problem. It offered yield when yields were scarce. It offered stability when volatility felt contained. It fit perfectly inside the logic of the moment. Early adopters entered cautiously. Position sizes were modest. Assumptions were tested. Returns arrived steadily without drama. The strategy proved itself quietly, month after month, quarter after quarter, enough to attract attention, but not enough to feel crowded. That is when imitation began. Not reckless copying, but thoughtful replication. Peers adjusted allocations. Competitors refined structures. Capital flowed in gradually. With more participation came validation. The trade gained credibility. Its risks felt understood. Its mechanics felt repeatable. Performance data multiplied. Track records lengthened. Confidence hardened into consensus. What few acknowledged was that the trade's success depended on scarcity, limited participation, flexible exits, room to maneuver. As capital poured in, those conditions changed. Liquidity thinned relative to size. Returns compressed. Sensitivity increased. But by then, the narrative was powerful. This wasn't speculation. It was strategy. Not a bet, but a framework. Late entrants didn't see risk. They saw proof. Years of returns. Institutional endorsement. Familiar names attached to the idea. The trade became a reference point. A benchmark. Something you explained if you didn't own it. And that was the moment everything shifted. Because trades don't fail when they're wrong. They fail when they're full. The reveal had begun, not with losses, but with convergence. As participation grew, the trade began to change its character, though few noticed it in real time. The mechanics were identical, the logic unchanged. Yet the behavior underneath was no longer the same. More capital meant larger positions. Larger positions meant exits mattered more. And exits quietly became harder. At first, this showed up as small frictions. Returns arrived, but with slightly more volatility. Execution took longer. Pricing felt less forgiving. Nothing alarming. Nothing decisive. Just enough to explain away. Managers reassured investors. Models adjusted assumptions. Risk was recalibrated, not reconsidered. The trade was now too familiar to doubt. Its story had been told too many times. Its success repeated too consistently. But consensus changes incentives. When everyone believes in the same outcome, positioning aligns, and alignment reduces flexibility. What once relied on dispersion now relied on coordination. Everyone expected to move in sequence. No one planned to move first. As market conditions shifted, sensitivity increased. Small changes in rates, minor funding stresses, subtle volatility upticks. Each one mattered more than before. The trade no longer absorbed shocks. It transmitted them, because size amplifies response. Attempts to hedge added complexity. Hedges required liquidity. Liquidity required cooperation, and cooperation thinned under pressure. Late entrants felt trapped by timing. Early entrants felt constrained by scale. No one felt comfortable exiting. This is the hidden conflict of crowded success. The idea remained sound, but the environment no longer supports it. Performance flattened, not because the trade failed, but because it had become fragile. And fragility rarely announces itself clearly. It appears as inconvenience, as discomfort, as unexplained deviation. The market was not rejecting the trade. It was testing its limits. And limits, once reached, changed behavior fast. What looked like stability was actually dependence. Dependence on conditions staying just right. Dependence on others staying invested. The trade everyone copied had reached its turning point, not in theory, in practice. And the tension was now unavoidable. The conflict surfaced when conditions stopped cooperating, not dramatically, incrementally, just enough to force decisions that had been postponed too long. A modest shock arrived. Nothing historic, nothing that should have mattered, but it did. Positions reacted faster than expected. Correlations tightened. Liquidity responded selectively. What had once been a smooth unwind became a negotiation. Every attempt to reduce exposure moved prices. Every movement revealed how crowded the trade had become. Participants realized they were no longer reacting to fundamentals. They were reacting to each other. Early exits created pressure. Pressure changed pricing. Pricing altered risk signals. Signals triggered more exits. The feedback loop tightened. Those who believed in the trade's long-term logic hesitated. Selling felt like abandoning conviction. Holding felt like ignoring reality. Late entrants faced the hardest choice. They had no margin, no history of gains to absorb losses. Every move was consequential. The trade's original edge disappeared, not because the idea was flawed, but because the conditions that created it were gone. Size had become the enemy. What once generated stability now amplified instability. Scale erased discretion. Risk managers intervened. Limits were enforced. Exposure caps were hit, but enforcement accelerated the process. The unwind wasn't chaotic. It was orderly, then sudden. Orderly while liquidity existed. Sudden when it didn't. Confidence fractured unevenly. Some exited early enough to preserve gains. Others waited for a rebound that never fully arrived. The trade didn't collapse. It compressed. Returns vanished. Volatility remained. And that was worse, because compressed trades don't reset cleanly. They linger. They trap capital. They demand patience without reward. The market had delivered its verdict, not through a crash, but through exhaustion. The buildup reached its peak here, in the realization that copying success does not recreate conditions. It accelerates their end. And once a trade becomes consensus, its future is no longer its own. The climax did not arrive as a sudden collapse. It arrived as acceptance. The quiet understanding that the trade's best days were already behind it. What followed was not panic selling, but slow withdrawal. Capital didn't rush out. It drifted, looking for ideas that still felt uncrowded, still flexible, still early. The resolution was subtle. The trade remained in portfolios, but no longer at the center. Its role diminished. Its influence faded. What once felt essential became optional. What once defined performance became background noise. This story matters because markets reward originality, but punish replication. The first investor is paid for uncertainty. The last investor pays for certainty. Success attracts attention. Attention attracts capital. And capital, when it arrives all at once, changes the rules. The lesson isn't to avoid popular ideas. It's to recognize when popularity replaces edge. To understand that timing is not shared equally, even when information is. Every cycle produces trades that feel inevitable in hindsight, but inevitability is usually a signal that opportunity has already passed. The danger is not missing the trade. It's arriving after conditions that made it work are gone, because by the time everyone agrees, the market has already moved on. The trade